meant that institutional allocators in particular, pension funds, endowments, and foundations, had to pay attention to the space. They looked at the returns, they looked at this proliferation of new managers and had to say, wait a second, there's stuff going on here. Let me pay a little bit more attention to it.
All right, episode 22 of the Deal Ranch podcast. Chris Acito, CEO of Gapstow Capital Partners. Thanks for coming on the show and thanks for hosting me in your home away from home, new office, so to speak here.
It's great to be here, man. Thanks for coming in.
Absolutely. Can you? I want to do your brand and your business as best I can here. Can you give an intro on yourself as CEO and then an overview of Gapstow?
An opportunity to talk about myself,
Absolutely.
Matt. That's wonderful. Gapstow Capital Partners is a registered investment advisor in New York City, where we are today. Our specialization for the last 15 years has been in advising clients on the opportunities within the alternative credit market. To define alternative credit, those are, I guess, at its most basic, forms of debt and debt-based investments that have a higher risk, return, yield profile than do traditional investment grade or perhaps more credit-worthy investment opportunities. That's kind of the common denominator within it all. Of course, there are many forms of alternative credit on the vehicle side or the security side. Alternative credit spans traded debt, like broadly syndicated loans, high-yield bonds. It includes structured credit, whether it be mortgage-backed securities, CMBS, distressed forms of credit. And then a big category these days is direct lending. I would kind of put those as the four big ones. Traded, structured, distressed, private lending. That's the alternative credit world. And importantly, it spans the many borrower categories, though. Corporations borrow, but households borrow, both for their property as well as just consumer finance. Commercial real estate. So we're sitting here in downtown Manhattan, big consumer of financing, not all of which is applicable for a bank and a bank's balance sheet that groups that are owning these big buildings will tap capital markets or private sources as well. And financial institutions borrow and sovereigns borrow. So it's a very big space in which to be operating. And it's really emerged over the last 15 years. And that's not to say forms of alternative credit below investment grade credit didn't exist, say before the GFC. But I think from an allocator's perspective, an institutional investor, an individual investor, the opportunities for investing in those markets and the desire to do that has really been a last 15 years, arguably a last 5 to 8 year phenomenon where you've seen interest grow in private lending and structured credit and CLOs. We're kind of entering I wouldn't call it a heyday, but I think alternative credit has emerged as an asset class. Perhaps that's a more clinical way of establishing the fact that this has become a big category. And so Gapstow was formed 15 years ago with this space in mind, and so we've been able to ride investor interest and capital markets interest in these areas for the last 15 years.
I love it. It's a wildly exciting time to be in any debt-based industry. I think right now it's a little bit turbulent, so it'll be cool, especially real estate related, to talk about an exciting index that you guys created. But as far as an overview on Gapstow for a listener from a services or kind of managed index perspective, like how would you best say describes like you guys do a lot of good research articles you sent to me that was nice to review. You also manage 30 plus ish indexes from what I read.
We construct them, right? Yeah. So our primary business, again, as a registered investment advisor, we help historically have managed our own funds or helped other people manage their funds in the area, so to speak, as kind of a sub-advisor or in some cases as a specialized index provider, which we'll get into. For us, Gapstow is not, though, about making investments in individual securities. We have been, our expertise has been in the fund of funds construction, multi-manager construction. So whether it be our funds or other funds, our specialization is then finding funds to which those funds can allocate in those areas. So as a result, we've had to get to know the ecosystem broadly within alternative credit, knowing the funds, knowing the managers that manage those funds, knowing the capital markets and flows and what investors are interested in. That's our business, pulling together multi-manager products in the alternative credit space.
Perfect. We were chatting a little bit about it before, but can you give an overview from your Duke days to maybe starting Gapstow? I know we were just talking about your son there too, but your days from Duke, and how do you evolve into this credit space, and what kept you interested in alternative credit throughout the years as well?
Yeah, so well, you mentioned Duke. That's where I went to college. I graduated from Duke thinking I was going to be an economics professor. And so I went to graduate school in economics and took a job in Washington as an economist. I was thinking I would be, again, somebody who studies, my specialization was macro and financial markets. So I was, certainly had an interest in finance, but I thought I would be pursuing much more of an academic or maybe a public policy route for economics. But in DC, I hooked up with a couple people who were doing management consulting work. That sounded pretty interesting. They were working at McKinsey and Bain, Boston Consulting Group, Booz Allen, and I was like, that's really interesting. And I was able to connect with Booz Allen, who at the time had a specialization in banking and capital markets. I thought that was my interest. Maybe I should try management consulting. I could keep my interest in finance going, but try this interesting application. And a little bit through serendipity, I happened to get staffed on a couple of projects working for asset managers. I'm like, this is kind of an interesting industry. Again, based on finance, I like that. I like portfolio theory. A lot of my background in graduate and undergraduate economics was coming to play here. And I kept writing the asset management industry is kind of my bailiwick that allowed me to progress at Booz Allen. And then ultimately got a call from John Casey and Kevin Quirk to say, if you like asset management, you should really come and do asset management work. We want to build a firm that specializes in just working with asset management companies. And so, that was the work that I began to do. It continued on with a firm called Casey Quirk and Acito, which still remains as Casey Quirk. And the specialization there was doing management consulting, strategic consulting 101, but again, with asset managers as the only client base.
Right.
Issues of how to grow. Should we be international? Should we introduce these products? Something's not going right in our investment process. How do we address all of these questions? And CQA was specialized and continues to be specialized in being able to address those issues. I did get an opportunity, though, as much as I loved working with John and Kevin, best partners I've ever had, to have an opportunity to build a business within InvestCorp, which is a global private equity firm, real estate firm. Now I think would be described as an alternatives firm overall, which was really exciting. It was a multi-manager, hedge fund-oriented business. They ultimately grew to multiple billions of dollars. And again, kind of got my business building skills combined with, again, my continued interest in finance. And I really liked the multi-manager world. And we had a successful run during the heydays of pre-GFC. But it was at InvestCorp where I began to think about, well, what comes next? And it was pre-GFC, but there were signs that credit could kind of be interesting. So this was John Paulson's famous short fund when he's shorting mortgages, and you began to see cracks in, there was the Bear Stearns hedge fund, a wind-up that would cause news. I mean, little did we know what was coming, but the observation was I like multi-manager work, putting together portfolios of other managers. Credit seems like a really interesting and emerging opportunity. Why don't we do any more of it?
Right.
And you know, the reason was, and InvestCorp, despite the fact we were very successful and big at doing multi-manager work, we didn't have much in credit. And I'm like, why is that? And then a little bit of a reminder about capital markets at the time, which was if you had a bad loan you needed to sell or a special situation that needed to get funded, you were typically going to a prop desk at a big bank.
Mm.
And that was where it was, that there was no community of managers. Of course, there were a few direct lenders. Yes,
Right.
there were a few hedge funds that did mortgages or credit, but nothing that really began to look like the industry we had today. In fact, I caught at least for alternative credit investing, the big bang was the global financial crisis. And it wasn't simply because it was a monumental social, political, and economic event, but what it did was it really began to push all this expertise for investing in, managing, curating, working out, you know, cuspier credits, and push that out of the banks, especially with Dodd-Frank and use of capital and prop trading restrictions, pushed it out into the buy side. And you had this mass proliferation of managers who were doing hedge fund work and direct lending, and this big bang of early there. And Gapstow just happened to be there. We launched at the beginning of 2009, first quarter, and it was with the goal of saying, you know what, if a typical investment consultant or other fund of funds didn't have much background in credit, and again, why should they?
Right.
Because it really wasn't as big of an asset class relative to equity long-short managers and macro managers and CTAs. Why would you spend much time there? Well, wait a second. Now here comes this whole new wave of capital managers and opportunities that have to be put together. And the goal was, could Gapstow sit at the middle and of all that and be, again, arguably the first specialized investor in working through that alternative credit ecosystem. So that was Duke to Gapstow in 2009 in hopefully less than
minutes.
87 minutes.
That was perfect.
Yeah.
So what was the initial, you saw this opportunity in the market as kind of like the tectonic plates of the credit market start to shift, and it creates this opportunity for you. You know, it's different starting a business. What this day one, what did those first couple of years look like? Did you have an idea of like what the first product, service, fund would be, like index? Like where was your first, like, hey, we're going to claw into this?
Well, the first one was a multi-strategy credit fund, meaning if you gave us $1, we would allocate it across 15 to 20 sub-funds, but it would be diversified. So you'd get some exposure to CMBS and residential mortgage securities and distressed corporate credit and esoteric structured credit and direct lending, this private fund formats, private fund raised and invested.
Was this your fund?
This was our fund, and that we kicked off. And what was it like? It was, first of all, we were very lucky. We were in the right spot at the right time. And I say that for a couple of reasons. First of all, it was a situation in which markets had began to come back. For those of us with a few more gray hairs, you'll remember that credit markets began to rebound quicker than the equity markets did during that period of time. In 2009, credit began to draw attention in this early stage. Again, a lot of it was rebound trades, how to get money to work in distressed mortgages that, mortgage securities that, because of very understandable reasons, were being offloaded off of balance sheets that needed to be picked up at severely discounted prices. Yeah. You didn't know what the holding period was for the world to come around to realize that value, but you saw value there. And how do you put there? And Gapstow happened to be in the middle of when that began to happen. And so the first year was scrambling, and it was a little bit of a combination of, first of all, belief that the market would begin to heal itself. On the other hand, you're like, it's not clear when that will happen, how long are we going to be working? Are we going to get a lost decade here in the economy?
Right.
I mean, we were discussing things back at that point in time. And again, thankfully the markets began to heal themselves. And for the first, I would call it maybe 3 to 4 years, call it through the end of the Euro crisis, a lot of the credit opportunities were more distressed in their orientation, either because there were bankruptcies or because there were a lot of forced sellers and not a lot of buyers, or because there weren't buyers because people were only learning to learn these areas. And, that was a very interesting run. Thankfully, that also allows you to put up good performance because you're riding a nice wave there. And I think most importantly for the evolution of the industry, it meant that institutional allocators in particular, pension funds, endowments, and foundations, had to pay attention to the space. They looked at the returns. They looked at this proliferation of new managers and had to say, wait a second, there's stuff going on here. Let me pay a little bit more attention to it. Now, at first it was very ad hoc, meaning I don't have an allocation for credit, but I can use some of my private equity money for lockup situations, or maybe some of the more liquid can fit in my fixed income allocation, or I've got real estate money. Maybe I'll just do distressed real estate mortgages instead of equity. I'll ad hoc it for a while. In the mid-teens, that began to shift a little bit, particularly as those distressed opportunities began to wane. And people got back to the business of systematically making loans and new issuance coming out. CLOs started to be created again. Direct lending deals started to happen. Commercial real estate began to become active again. I'm obviously painting with a little bit of a broad brush here. But that new issuance began, that I call it the second great wave of credit investing, which has lasted arguably through 2012. And this is where the emergence of an asset class happens. And it's wind forward to today. It is not atypical that if you spoke to a public pension plan, pick your favorite state pension, that they have an allocation to credit now, distinct from fixed income, distinct from private equity. That would not be atypical. And they have a goal associated with it in terms of how much money to get to work within that, which is, of course, as soon as you get allocation goals, you start money flowing. And you've seen credit as an industry grow substantially from an asset management standpoint. And, that's allowed the maturation of managers who in 2009 and 10 were people starting up in rooms not bigger than the one we're in today, right. Saying let's start a business, to turning around going, oh my goodness, we're 10 billion, we're 50 billion, we're now over 100 billion. How do we manage this growth? How do we grow going forward? And we can talk about it later if you'd like to. I think that trend is only kind of getting started. That there's another great wave of credit investing that we're about to get into.
Absolutely. Before transitioning into the real estate portion, through one of the reports I think you had sent me, it showed the year-over-year growth of how much alternative credit, you're saying credit as a whole is growing in these pension plan, right? Asset allocation, but alternative credit being a subset of that is representing like more than 9% of allocation for a pension, which seems extraordinarily high.
Yeah, well, considering, when we talk about this 15 years ago, that would have been zero.
Yeah.
I mean, maybe they had some allocations, but again, it wasn't a recognized thing and it was small. To where now people say, no, I'm going to get that much money. And it's not atypical for some of those pensions to have double-digit allocations now. 9 is the average, considering some people are just getting started.
Of course.
People more along the way are, thinking about the opportunity to put significant money to work in private lending. Has been the primary beneficiary, but it's now with the rates up again, people are reconsidering high-yield bonds and broadly syndicated loans. It was one thing when that was yielding 4.5%. It's another one, it's 8 or 8.5. That becomes a real interesting complement. I wouldn't say substitute for private lending or structured credit, but at least it's part of the opportunity set as from a practical perspective.
Absolutely. So is bridging us to the new index here. A couple questions just about indexes as a whole, or even the index business, really.
Yeah.
So you've been in business 14 years or setting this out, but you've been in the credit industry for a long time.
Yeah.
This may be a green question of me, but how does one get into the index business? What is the value to your customers? Like, when was your first index that you guys created? How's that facilitated? Are asset managers coming to you for you to put together a benchmark, so to speak?
Yeah, it happened organically. 2009, we had to answer, among many questions, a very interesting one, which was, are our own funds doing any good? How do we measure performance? How do we know if we're doing well here? If you were a mutual fund, you could go to Morningstar and see if I was doing well. If you were a long-short equity manager, there were multiple hedge fund databases. But what if you were investing in this opportunistic credit fund? Where are they? Nobody's covering that. And so the need to say, on average, if I chose that fund, who are the peers that I could have invested in, and did I do better, at least than average, than that? And so from early on, we began the indexing business of putting together peer groups of funds that we thought were similar in structure and strategy in order to judge our own performance, in order to judge the performance of potentially future investments. And so it was a real need that we began to have. Now, other index providers over the years began to enter that space, but from 2009 we've been really active. At first, it began with hedge fund products, meaning funds that are private but open-ended. We've, though, over the years added peer groups in the interval fund space, lockup funds, and then, as we'll talk about today, the listed funds, so business development companies and commercial real estate REITs, closed-end funds. Those were all options that investors have for investing. So, geez, if that's part of the investable universe, I better have a way to measure it so I can tell if this fund I'm looking at is doing well, if our funds are doing well, if clients have funds that want to measure how well they're doing. That was the genesis of the business. And what again was an ad hoc, we've now kind of systematically said, we've got this collection of indices that we make known to people and report on them. We sent out our Q4 report this morning, and people find it really helpful to gauge again just how well things. It's all these things are. Have to come with assumptions but at least it's a directional assumption of how well am I doing? Because we all remember when we were, super duper and we looked great. How about some objective data to be able to say, I was at least above or below average relative to what are reasonably comparable things? Because that's important to know. It's not just thump your chest about it, but it's how you learn. It's how you learn. Well, geez, I didn't choose that fund to invest in. I chose this one. Why was that? They did very differently. Again, I don't want to beat myself up if my fund did worse, but I want to understand. Did the manager just do something wrong? Or is it, wait a second, even though these are nominally close in strategy, wait a second, one person takes a lot more risk than my manager was. And this happened to be a period of time in which risk was on. Okay, I could see why. I'm not going to get mad at my manager. I knew what I was investing in. Just these other managers are doing something slightly different. That's, again, the purpose of indices is my perspective to learn.
This episode of The Deal Ranch is brought to you by Reed's Jewelers. If you're looking for a new watch, Reed's has it. They have a large selection of fine Swiss timepieces from Omega, IWC, Breitling, Grand Seiko, Tudor, and Tag Heuer. Since 1946, Reed's has been devoted to customer service and quality. Find a Reed's store near you or shop online at reeds.com. That's REEDS.com by clicking the link in the show notes. I think that's a perfect transition into this new indice that you have. That's very fascinating to me, and more putting the real estate hat on here. So Chris Sullivan at Crafton Capital would thank you to Chris for setting this
Thanks,
up,
Chris.
obviously. But I asked him, if he has anyone that would be interested to come on the show and talk about real estate. And he said the Gapstow Real Estate Income Index, you guys had just put together in the last maybe 18 months, mm-hmm. right? But then the Axis Real Estate Income ETF is tracking it. And that started this August 28th, I think.
That's correct.
So we can use this, so to speak, as our deal story. We usually cover one deal on each podcast. Can you give an overview of this index, right? It's a mortgage REIT index that tracks 50% commercial mortgage REITs, another 25% agency, residential REITs, and then non-agent, the other 25% non-agency. I'll pass it to you as far as can you give an intro as to the origin of how did Axis and you guys come together in maybe forming the index?
Yeah, well, it began with
the purpose.
Yeah, it began with a need, which was twofold. What's a way to get access, no pun intended, obviously though pun intended, to commercial and residential real estate debt, but do so in a wrapper that is liquid. If we were working in private funds and could be totally illiquid, you would go around to a couple of real estate lenders and say, I'll invest in your private fund. I know it's locked up for 12 years, but it's okay. I understand why you do that. But in this case, the constraint was, no, it's got to be daily tradable. Well, wait a second. How do you square that circle? The answer was, well, there as many of the managers, in fact, there's some of them the same, who do private funds also do listed funds, meaning that the investment vehicle, rather than being controlled by a general partnership, is actually listed on an exchange. Yeah. And you can buy and sell the shares of that fund on an ongoing basis. And so if you wanted to get in, you could buy those shares today. If you wanted to go out, you could sell those today. You could mm-hmm. sell them within the minutes that it takes to fire up your brokerage account on your phone. Those funds that trade daily are, in the real estate's case, mortgage REITs, and to a lesser extent closed-end funds. But why don't we stay focused on the mortgage REIT space? Most people are familiar with REITs. Typically speaking, though, it's equity REITs, meaning they get it. Right. They give a REIT manager $1 and they buy buildings. Mm-hmm. And that is certainly 85+% of the REIT market are equity REITs. But there is a smaller minority of mortgage REITs. And they have the same stated purpose from a social good standpoint. They're given tax treatment such that they focus on the development of real estate. But unlike buying buildings, they finance buildings, or they finance houses directly or indirectly. And because they trade on a daily basis, this is the ability to say, wait a second, I'm buying into an entity that makes commercial real estate loans, but I'm not doing that in a locked up format. I can actually trade that ownership stake I have on a regular basis. So that kind of squares the circle, being able to invest in some of these less liquid asset classes, but being able to do so in an ETF wrapper. That was what we were trying to put together doing this. And then having that little bit of insight into investing in traded, listed mortgage REITs, it then became a question of, well, how do we put together a good index that measures that? Mm-hmm. And happy to get into that if that would be.
Yeah, I think that's a good transition. So again, just in case I did mention, so the ticker's RINC, RINC, Axis Real Estate Income. That's the ETF that tracks your index, correct. Right? Can you talk about the qualification that each of those mREITs need to meet to make it into your index? And then secondarily to that, how did you determine the asset allocation of the 50 commercial, 50 residential? Because it's kind of neat.
Yeah, so 50-50. That was, I guess that was more conceptual.
Yeah.
In that those are the two big opportunity sets within real estate.
Mm-hmm.
They're the two big opportunity sets within the mortgage REIT market. Rather than trying to get too clever about tactically tilting to one to the other, if in fact the product and the index is meant to be a longer term oriented investment approach to the REIT market, why not make it 50-50? Now, it turns out market capitalization is significant in both of those areas. So it wasn't like commercial real estate is this big and mortgage REITs are giant.
Right.
Residential, it more or less fit that. So conceptually, that's where we wanted to get to. And then we also wanted to make sure on the residential side to keep a balance between agency issuance and non-agency origination, just because those are two different and important markets overall. So we do think those sectors within the residential and commercial lending markets are interesting. They're helpful in an asset allocation scheme, and this could be a turnkey product for being able to approach it. And again, not trying to outguess ourselves on picking individual sectors, like I believe one versus the other, that over time, hopefully both are important and provide some value. And then the other construction component to it was beginning to think about what are the right ways to then weight the underlying constituents. And there we took a very specific approach, which is a little bit different than many people take in creating REIT-oriented indices, which is we did an equally weighted index. As with any index, I mean, think about the S&P 500 and how much the Magnificent Seven represent of even a gigantic index. You have similar skews in the mortgage REIT market. What we didn't want people to worry about was, am I taking too much risk in BXMT, Blackstone's REIT, or agency? That's not a value judgment against those companies. It's actually what we want people to think about is the sector, and therefore being able to make sure that the weighting is diversified across the number of holdings that are in each of the categories, and keeping the underlying constituents to a more modest number than would be implied by the cap weighting. And it works the opposite too, that some of the smaller mortgage REITs are given greater expression in our index than they might be if they were just given capitalization. So in summary, it's a turnkey approach to say, you know what, I like lending to real estate.
Yeah.
I'd love to take exposure to both commercial and residential, and I'd like to have it pretty well diversified amongst all the underlying constituents, because, again, I want to express the general sector idea and concept, not worry about any individual particular names more so than others.
That makes sense. I picked through, and I'm familiar with some of these, but I picked through some of the ones that I wasn't. And one thing that I was curious about, so we have this commercial, these commercial mREITs, and then with these residential, but even in the residential, there's also multifamily assets, correct, in some of the...
There will always be a little cross-pollination between the two. Most of the multifamily is going to be expressed through the commercial side of things.
I saw maybe some properties were in the... Could be the agency and for residential.
It could be, and you will pick up
just like any other fund.
And they're within agency. Agencies do produce CMBS securities in addition to RMBS, so you pick up a little bit of that. But I think when thinking about lending to multifamily, the biggest expression will be through the commercial side, and I directionally that's probably about. If you look through all of the underlying REITs within the index, that's probably about 25-30% of their exposure.
Right. So what is the process, great overview of the index and the purpose. How did that relationship with Access begin, or in what was their focal point? I guess you already touched on it a little bit, but what is the process in rolling out the index? So I think it started tracking, or you guys launched the index, so to speak, in May. It's back tested through 2013, but this is fascinating to me. So what's the roll-up process for the next 18 months till like the index goes live? Like, what is that time frame like?
Well, we began to think about it. I mean, Gapstow had been creating index and tracking the universe of mortgage REITs for quite some time. Mm-hmm. So what it came down to was not totally we were not unfamiliar with the area. What it did come down to, though, was thinking about a particular use case for a match. And, to be honest, we had this idea for a while, mm-hmm. which is, just doing a dedicated mortgage REIT structure. We had, back test and, a proof of concept idea. And the Access Group was ready to launch a high income, high yield oriented product, or restructure one that existed. And the question became, would this be a good match? Would clients like to think of a different form of high yield and high income than just traditional junk bonds? And that through a mutual friend, we kind of made a match that said that, okay, Gapstow, that concept's pretty good. And I think we've got a product that could begin tracking it. Let's begin to really work towards solidifying it. So we in the index business, most of our indices always start off as, someone at the Gapstow office, working on a spreadsheet and, ad hocing it and figuring out as we go along. For when you're beginning to talk about managed product, of course, then the level of construction and the sophistication around that goes up several notches. And so it was formalizing the approach, coming up with a series of objective rules as to what goes in the index and not in the index. Again, not just, it's okay, we'll put them in this quarter, not the next.
What were those rules? Are those you're just saying the qualification standards as far as like market cap and
trading volume? Yeah, exactly. So that's where, so first of all, the part that Gapstow maintains on an ongoing basis is just what is the eligible universe, and then categorizing all of the eligible mREITs into the categories of non-agency, agency, and commercial. We can drop down from there, but that's really the organizing spot, as we've talked about. Having done that, then how do you pull it together? Well, the objective rules are, first of all, you've got to meet certain eligibility, and as you mentioned, market cap and trading volume. They're related.
Okay.
We're a first level of threshold because in the back of our mind, we knew this was going to be the basis of a potential investable product, and we wanted to make sure that there was enough liquidity in the market to be able to affect an ETF. And there's some mortgage REITs, they're just tiny.
Yeah.
And I'm sure you've had experience trading microcap stocks, and it's in this day of age of electronics trading, you still sometimes have to do this by appointment in certain areas. And certainly in ETF, that would not be beneficial. So we had to put some real world constraints around what we thought would be objective rules for doing it. And then we found a very good partner who is the calculation agent, a group called Mercube, who we then, because you also want an objectivity to this, turned the rule book, which is a formal document, over to Mercube and said, guys, can you calculate this on an ongoing basis for the use? And so the index gets calculated on a daily basis. There is an update and a reweighting and a reconstruction process that happens quarterly around it, but Mercube is expert in being able to maintain that on an ongoing basis. And, Gapstow is still the keeper of the methodology, but they're there. So, we can say very objectively, there's no ambiguity of what's in the index or not. Oh, Gapstow or Acito, you guys are, thinking about this, and how did this get in versus we just look at the rule book. And, there's this very helpful, objective third party who's, kind of the gatekeeper of making sure it's getting done correctly.
Fascinating. Was there any, just looking at, if you look at the Dayton paper, it's interesting time to roll out a mortgage rate while it almost while rates start to run through the roof, right? Especially up maybe listen to one of your other shows. Yeah. And from years ago, you're talking about just like how maybe low margin the credit business was, and rates had been stable for so long, or maybe so low for so long, and then boom, mortgage rate, and then rates skyrocket. Did that add? Yeah. What were the complexities in bringing in a mortgage rate index to market during this time? Because there's a lot to it.
It was tricky. So first, maybe mention the bringing it to market was there was never a timing issue. Oh, we got to wait.
Of course, not. Right.
So there was a series of external events that just said, actually, here's probably a year in advance when we're going to launch. So you don't know what's going on.
Got it.
So let's think about the macro environment. I mean, 2023 was this really fascinating year. If you looked end to end, it wasn't all that exciting. Risk-free rates basically ended where they started, and spreads came in a lot. Okay, that's kind of directionally what we came on. Okay, but what a roller coaster, right? We began with a banking crisis in February going into March, and then we began the 7-month incessant creep up in interest rates over and over and over until November, and then spreads came in and rates collapsed, and we had this massive bull run in the last 2 months. So the product launching in August was still in that grind higher interest rate environment, and the moves were quite substantial. And so that is a difficult one. Well, there are two things that were difficult in that environment. We're familiar with the rates going up. The other thing that was characteristic of 2023 is the yield curve stayed inverted. At best, almost reached flat and then inverted again. We've never seen such a duration or magnitude of yield curve inversion, which for a carry business is challenging. So think of the double, triple, quadruple whammy you have. You've got rates going up, which makes mortgage origination more challenging, so new flow is coming in. Also, for people who are holding mortgage-backed securities, fingers crossed they don't have to sell, but the markdown is substantial because a lot of those are fixed rate. But also now, with this yield curve inversion, you're financing shorter term to hold these longer term. That carry, that net interest margin is flat, maybe even negative in certain circumstances, and not getting better. And so, that as the year grew on, and many mortgage REITs will hedge interest rates to some extent, but the order of magnitude of changes, I mean, we've never seen anything quite like we have over the last 24 months. And so that's an imperfect science at best. And that was, again, flat yield curve, rising rates. I mean, let alone everybody concerned, too, on the commercial side about office space and, here comes a recession. And so the first month to two were, that was a really challenging period of time from a performance standpoint, from, and REITs were not alone in this regard. Banks are challenged by the same issues. It was a brutal year for banks, or at least certain parts of it were, where banks are investors in, loans and MBS that get marked down with rates going up, and yet their funding is, ugly. Yeah. Thankfully, somebody decided at the end of October that this was enough, and we then had a very constructive rally through the last 60 days of the year, which was equally in some ways unprecedented, where I guess we all decided rates would start coming down. Yield curve is still not normalized, but at least people's views of the interest rate trajectory, I think, have changed, as have, I think, people's concerns about recession, and refinancings, and again, how the world takes all these animal spirits into account. Not sure, but it certainly changed towards the end of the year. So things got better.
Exactly. Maybe we can't answer this question. I don't want it to be like asking it the genie for the answer. But one thing that stands out, obviously, with these mortgage REITs is just how many large commercial assets have loans that are coming to maturity in the next couple of years, and then their rate's going to go up depending on when their loan comes due. How does that affect the performance of these mortgage REITs, where maybe these loans will be paid off, or people maybe they're getting extensions? How does that complicate the product? Or it's going to complicate everything for a lot of people.
Well, it's going to and different effects for both the residential and commercial side.
Right.
On the residential side, in some ways, it's an easier, although interesting picture, which is you know this very well, which is market's kind of at a standstill, right? With mortgages where they are, people don't want to or can't move out of their existing house. Yeah, it's tough for new people to buy. And so, there's the taunt of buyers and sellers who are just...
this locked up supply almost.
Yeah. And so, at some point with that's got to budge a bit. When that happens, is it 6 months, 12 months? You'd be better able to gauge than I. But it's not a credit quality issue, right? No one's worried about people paying their mortgage, or you're always worried if you're a lender, but relative to other periods of time, actually, despite what we panicked about, rightly so, in the global financial crisis 15 years, mortgage quality right now is phenomenal. The average borrower has a ton of equity, is a higher credit-worthy borrower all told. When we speak of the RMBS or resi loan market, we're concerned much more about rates and prepayment speeds.
Yeah.
We're not concerned about, are we going to get a wave of defaults coming in? Right. The opposite is somewhat true on the commercial side, which is this is where people are concerned about people's ability to refinance and the outlook overall. I do remind people when thinking about this that commercial's a really broad space, though. Yeah. We're all drawn to office because, frankly, that's what the headline is. At least if you live in a downtown area, that's what you see around you. But office is a minority of the market overall. That's not to belittle; it's a big piece. But there's multifamily, and there's industrial, and there's healthcare, and there are so many different sectors, hotels. Within the commercial, and one has to be a little bit careful about diagnosis. Certainly, there are some sectors within commercial that's doing fine. I mean, industrial properties, great to lend to. I mean, as warehousing and supply chains coming back to the U.S., that's a strong credit or stronger credits. We're worried about office, though. Office is work from home and not enough space needed anymore, and will people actually be able to continue to pay their mortgage? That's even before getting to, can they afford to refinance it or get refinancing at all coming up? And so, obviously those claims are very legitimate. I wish for all of society we had a great answer to how we're going to turn all these, again, in our case, Manhattan real estate into something else. How does that work its way into the commercial mortgage REITs? Well, first of all, commercial mortgage REITs are required to value their loans and do so they're public companies. Yep. You have to come and get some form of valuation. Now, valuing an illiquid asset we know is an imperfect science and a little bit of art. That said, that's supposed to happen. You're also supposed to reserve against losses that you anticipate these days as well. So if trouble is coming, in theory, some of that already should be reflected in the net asset value of the commercial mortgage REIT itself. And so that should begin to happen. The other thing that can happen as well is, if the market doesn't believe that those reserves and those marks are sufficient, you can bid the share price down. Being a listed fund means that, I'm going to sell you my holding today. I know the net asset value says it's worth 100. I'll take 80 for it though. And, let's assume I'm not a forced seller that has a gun to my head about having to sell. It's just, look, I think things are going to get a lot worse than is currently reflected in the net asset value. Beginning of 2023, you saw that commercial mortgage REITs were in the 70 cents on the dollar from a price relative to the marked net asset value. Now that's crept back a lot, particularly in the last 60 days of 2023. Not still a fair amount away from book value, net asset value. So another way that sometimes gets expressed is the shareholders or share purchasers demanding a discount relative to net asset value relative to it. So you could say a lot of the challenges of commercial real estate, office in particular, that we anticipate over the next 12, 24, 36 months should be reflected in the net asset value today and the discount that commercial real estate REITs are still demanding.
That makes sense. One question that popped up while you were talking, this may be more remedial logic here, but for the residential mREITs, right, the latter half, 50%, is that product in any bit stronger that rates are rising? Because again, this logic I'm thinking is that while rates rise, are people less prone to pay off their mortgage so they don't have the liquidity risk? Is there less prepayment risk now because people are valuing, oh, wow, I have a 3.25% mortgage. Why would I pay this off? This is pretty cheap. Like,
sorry, on the resi side?
On the resi side, yeah.
Yeah. I mean, that's a challenge. Whether you were thinking about it or had to do it right now. Imagine if I've got a 3.25% mortgage personally.
Yeah.
If I had to move, I got a new job in California, I had to move. The idea of
keep it and rent it. Yeah.
Well, if that's an option, because otherwise I'm giving up my 3.5 to have to do 7. The math is pretty simple. That's more than doubling my out of pocket. For let's assume I stay in the same valued house. That's really challenging. I'm very reluctant to give that up. And whether that's because I choose not to do it or frankly, a lot of us couldn't afford it.
Yeah.
Right? We can't afford a doubling of our housing budget, which for most people is the largest expense within their personal financial budget. So I think the lock-in effect is a very, very, very real one.
And does that strengthen the mortgage rate performance? I guess that was more of the question, because that's certainly evident, but because there's a liquidity risk, I guess a lot of them have where they don't know when people are going to repay, so then you kind of end up with a bunch of cash on the books.
Yeah. So how does that flow through to the valuation of mortgage securities? Again, that's not a credit issue because, again, a lot of those people who are locked in their house may have been financially locked in, not literally locked in, have equity built up. They're not giving up on that. They also realize that they've got a good thing now with their mortgage. Maybe they used to complain about it. They're not complaining anymore. It's not a credit issue. If I'm a mortgage-backed security owner, the idea that someone is now going to be paying me for a longer period of time relative to what my cash flows might have been, depending on how you model that might be beneficial. Some of the mortgage REITs as well hold mortgage servicing rights. Those have been a really helpful balance to rising rates. If you are locked in a house and a mortgage servicing right is the payment stream associated with, as the name implies, the right to service that mortgage over time. If you bought it or owned it and had to value it, you assume that on average it would be outstanding for that amount of time. Well, if now you're assuming it's outstanding to here, that cash stream has been extended. So the rising rate has actually valued that asset at now even a higher level than before. And for a couple of the mortgage REITs where MSRs are a bigger part of their book, that was again, a very helpful counterbalance over the course of 2023 when rates were rising. Mortgage-backed securities valuations coming in, but mortgage servicing rights going up.
That's interesting. Anything else in kind of wrapping up a little bit? Anything else GREI related or RINC, like anything else that we miss as far as this index or the product? Do you think that you wanted to highlight at least?
Yeah, well, I think that we often get asked, the outlook, and what does it look like today for the index? And again, as the index provider, I can't really speak to the product from a compliance standpoint. But as I look at mortgage REITs, and I'm trying to paint the optimistic case, and to be fair, we'll take the bearish case as well. The optimistic case is that for all those things that were painful in 2023 up until the end of the year, that bond math works in reverse. What if one goes to a lower rate environment? I'm not a believer that we go back to zero. That's not going to happen. But there's a lot of room to come down. And as we've discussed, what happens if yield curve normalizes? 9 times out of 10 in the world, that's an upward sloping thing. And suddenly you're funding your assets for a lot less than you're getting from them over time. If you are looking for an exposure that will benefit from that normalization of yield curve and rates, as much punishment has happened in 2003, that's going to work in reverse if that begins to happen in 2024. Now, I'm speaking more to the residential mortgage REITs in that case, and especially if you're in a situation where you're not worried about credit quality so much. This is going to be a bond math duration sort of and net interest margin equation that could work. Now, the question then becomes: are you a believer that yield curve normalizes and rates begin to come down and mortgage market begins to flow a little bit more for normally? And again, if that doesn't happen, that won't be as supportive as they would otherwise. But again, that would be the interesting thing that I don't think many people think about when, how do I play a normalization of the yield curve? Sorry, I usually don't like to use play in investments. That's, but if my view is normalization of yield curve, well, you want to look for investment opportunities that are levered by borrowing short and lending long. Those will benefit from those. Banks, mortgage REITs, BDCs to a certain extent, certain consumer finance businesses. On the commercial side, what's the positive case here? The positive case would be that, again, I don't think anyone's a believer that office won't have problems. But if you believe that those are fairly reflective in a discounted current price and NAVs that have absorbed some of that future outlook, optimistic cases, it won't be as bad as we think it's going to be. And so therefore, coming in, if I think I'm getting an attractive enough valuation, that it wouldn't be there. And again, maybe some people would think, well, people have panicked a little too much about it. Maybe this is a buying opportunity going in. Because one feature we also didn't talk about, these are very yield-intensive investments. By construction, REITs have to distribute all of their income, or virtually all of their income. A levered credit business produces a lot of cash flow. And so while you're waiting for some of these, yields are now in the 11, 12, 13%
or even
range.
A little higher. Yeah,
even a little higher. Again, the last 2 months, I think positively have cut that yield a little bit, but it's still double digits. We're well into the double digits. And so while you're waiting for some of these catalysts to come in, there is a cash flow distribution that is pretty substantial that will offset some of the deterioration, perhaps in net asset value that will come. Obviously, the bear case to the commercial side is no. Recession. It's finally coming. I know we've been predicting that, for 4 years. It's finally coming. Yes, the wall of pain and the wall of refinancing is finally going to come due on office and other things. And by the way, we have been fooling ourselves. This is a lot more systematically challenging than we again had thought about. And that would be, ones where people begin to think about we were just way off in our thinking and calculus about how significant the social change brought about by work from home and people's thinking about office spaces, and let alone if recession comes, because then we're going to have knock on into hotels, and what if we don't start onshoring everything and we've overbuilt on industrial? Those are other things that are potentially going to come through. So
it's a good way to summarize.
So, like a really good economist, I've told you both sides without really picking one.
It's a fair point.
Yeah.
Okay, last couple questions for you. So we can steer away from real estate for your closing remarks as far as your business here. What opportunities, and I know we've kind of covered a lot of them, but with this tumultuous rate environment, like what opportunities do you see in credit or alternative credit for maybe real estate related, actually, for your clients or even your funds right now? Like what are you looking forward to in this market, or to see what unfolds in the next year or two?
So from a forward-looking view, I'm actually pretty bullish about the credit opportunities within real estate. Commercial first. I think one of the giant things that happened in 2023, we almost forget about it because God forbid it's 9 months ago, was we had 4 banks, 3 of whom were large, either fail or get pushed into a new ownership. Add to that Credit Suisse, although that's a different story and largely outside the U.S. Mm-hmm. Banking regulators really are pushing for banks to curtail lending, particularly in the commercial real estate space. Mm-hmm. That doesn't mean they're getting out of commercial real estate lending. That's a core part of banking. And banks bank real estate really well. But certainly at the margin, there are loans not being made that might have been made a while ago. This is a real phenomenon that of the trillions of dollars that banks have in commercial real estate, it doesn't take a big sliver of loans not being made anymore to make for a very significant opportunity for private lenders to begin to fill the void, and by private I mean non-bank lenders mm-hmm. coming in and being taking up that gap. Combine that with the fact that rates are higher and higher for longer. And again, we may debate, is it coming in 100 basis points? But again, maybe I'm projecting here. I don't think they're going back to where they were at close to zero, or as close as we can come to that. And so new loans are being issued at absolute levels that we haven't seen in a while. Okay, spreads again at the end of the year came in a bit, so that's offset it a little bit. Nonetheless, people are making loans for higher amounts than they were before. If the bank pullback results in spreads ultimately coming back a little bit more, this becomes a great opportunity for private capital to begin to step in and earn a good return on this. I think while one can get over enthusiastic about this, there's also an opportunity on the distress side. We can debate, is it, hopefully for all of us, it's not a catastrophic wave of real estate commercial failures. That said, I think we probably are anticipating a pickup going forward. Mm-hmm. We see it certainly anecdotally, and we begin to see a pickup in some of the metrics we've seen. For specialists in this area, I think we're going to see an opportunity. So as much as bright lights might be warning people, oh, stay away from commercial lending. Not even talking about the equity. Maybe you want to be wary of existing pools of loans that you'd have to comb through and see what's there. But for new activity going forward, purchasing a distressed loan, making a new loan, I think the environment's going to be very good. And we haven't seen it. We haven't seen the money flowing to commercial real estate lending like you would anticipate. That's partly just the psyche of, it's so where, my investment committee is wary of the space. I don't want to go near it. Yeah. For people who are willing to go there, that's only more appealing going forward. On the residential side, I think we're, I also think that will be an interesting opportunity. I think there, though, that forward-looking view is, if you had to put my personal belief is, I do think we begin to get more of a normalization within interest rates, or let's put it this way, at least. Probabilistically, does that dynamic get worse from here or get better if you're holding, say, mortgage-backed securities? Yeah. And I think given what's happened in 2023, that has moved more to the camp of higher probability for a normalization, which would help a lot of the mortgage REITs. It's challenging now. New origination's not happening. Things have to adjust going forward, and I think that would be the opportunity to begin to think about residential origination. And for many people who like it, there's certainly some private funds that do it, but one does forget that these things called mortgage REITs exist, both in traded and listed form as well as private form that perhaps have a very interesting 12 to 24 months in front of them.
That's right. Is there any? You've been in the credit or alternative credit business for a long time. Is there any service or market that you have or product that you haven't developed or been in that you want to? Anything that you haven't done that would be on your map moving forward?
That's a really interesting question. I think the space continues to grow. I think that the services for clients are changing too. And so I'll answer that less about a product than a service. I think there's greater need ever now for being able to work with clients on thinking about portfolios comprehensively. That what is credit? Okay, I need credit. Credit's different than equity risk. It's different than fixed income risk. I know it. The last few years I've established that I should have an allocation to it. I'll get started, do a couple of investments, but what's my end game here? And I think this is a year in which helping people think through, actually, what does a mature credit portfolio look like? How much of it is performing versus distressed? How much of it is corporate exposure versus consumer exposure versus commercial real estate versus municipal, and geographically, how diverse does it need to be? How much of it should be structured versus private lending versus traded credit? How do I think about getting that balance correct? Is now, I think, the stage at which the market has matured to. And I think that's the interesting debate that we've set up over this year and going forward, where this asset class takes its next step of development. It's here, it's real. What's that level of sophistication? What's the equivalent of 25 years ago when we said, well, it's just not equities, right? The Morningstar style boxes. They said at least there's cap dimension and a value versus growth dimension. Maybe I should think about putting together a combination in a more sophisticated way. It's not all private equity. There are lots of flavors: private buyout, venture. Now let's get into 16 subcategories. PE has gone through that level of greater sophistication. Fixed income did that 30 years ago. That I think credit now going forward, people are going to be thinking about how to do that. And I think it's an opportunity for advisory work where you're talking to people about that. It's also an opportunity for product where And I think you're really seeing this develop on the interval fund side, where people, especially on the individual side, wait a second, I don't have a staff, I don't have people to select 30 funds to create this matrixed approach to all those opportunities. Are there turnkey solutions for getting a broader set of opportunities? That I think that's a big wave in product development right now in the credit space.
Wow. Last question for you. You've been, especially in this great city, and there's a lot of unbelievable people here that I'm sure you've crossed paths with. Who do you think has helped you along the way the most, or is there any mentor that's kind of been, or maybe partner that you've partnered with? I know you mentioned Casey and Cork earlier, but who do you think helped you learn the most, or who did you gain a lot of value from in your career in the credit space?
Yeah, well, as much as I will always love Kevin Quirk, I mean, John Casey was somebody who was incredibly influential to my development as a person, but as also professionally. When I joined with John in 1998, I was pushing 30, and that was. John was nearly 60 at the time, and so his ability to, first of all, be willing to partner up with people who were, barely half his age, I think was always interesting. Secondly, a willingness to allow younger people to develop and take chances along with him were great. And then there was just the industry perspective as well, that, John really was one of the creators of the modern money management business, from the 70s going into the 80s. And so his ability to impart knowledge of, well, look at the way we are. How did we get here? John would be able to say, well, here's what happened, and here's how I lived it in real life. And that ability to impart knowledge and that experience was incredibly helpful now as I'm talking to my own clients, thinking about how did we get here, what's worked, what hasn't worked. Mm-hmm. It's not like everything's new. We've seen a bunch of things before and learned a few lessons. The question is whether or not you have that history and that perspective of thinking through the positives and the negatives that people think about asset allocation and what makes for a good manager. What's a fad versus what's tried and true? How do you think about investing over decades, not just months? John was fantastic in imparting that knowledge, and also fantastic in his willingness to impart all of that knowledge.
I love it. I think that's a great place to wrap. Is there anything else Gapstow related that you wanted to highlight in closing remarks? Well,
I think so. We're turning 15 this year, which is a big number, and I guess now the question is, what's the next 15? And again, I'm very encouraged in that I do think we're entering a third phase. Maybe a new podcast I'll tell you about what the third phase of alternative credit investing will be, but we've highlighted many of the features, which is, I think we're just getting started. Not that a lot of money hasn't already flowed.
Yeah.
More money will, and its sophistication as an asset class will continue to grow. Frankly, there are segments of the market like endowments and individual investors. They're just getting started. And so, this is going to be a very fruitful space over the next few years. The role of banks are changing. Mm-hmm. Let alone all the nearer term dynamics of work from home and other things, that it will be an exciting, certainly 5 years coming up for the asset class, for investors in the asset class, and those of us who try to be helpful in making all of that work together.
I think it'd be due for another episode in a year or two to see how it starts to unwind. But Chris, thanks for doing this. Thanks for hosting me. Thanks for coming on the show. I appreciate it.
Really enjoyed it, man.
Awesome.